All right. So first thing I think it's important just to kind of give you my background and my experience in the investing world. Out of college, I did get into retail loan officer. Um, Worked there right at the first all-time lows. It was almost like order taking, just refining, dealing directly with consumers. Had a really good time, but it gave me a good basis of the lending background. From there, I moved to a wholesale lender named First Franklin Financial. That was back right as the crash was, right before the crash, into the crash. I believe First Franklin was owned by Merrill Lynch, which if anybody on the line have seen The Big Short, we were front and center in The Big Short. A lot of that lending was to people that owned homes. It wasn't really on the investment side. And so, with Templeview Capital and everything that we lend on are going to be products that's all concerned with your investor and not to the homeowner themselves. So, a little bit different of a type of loan, but that was a really good opportunity to do business to business sales. And so I learned a lot at First Franklin. Um, and then once, that tailed off and, our severances ran out, I looked for another job and I found one in asset management. BSI Financial was a buyer of non-performing notes, and we purchased big pools of loans, and we did the workouts on those loans, whether they were workouts on people that were over equity in their house. They owe 400,000, the house was worth 300,000. And so they, wanted to keep the property. So we worked on either a modification, some sort of other loss mitigation tactics that involve, short sales, or we even did short payoffs. There's all kinds of things we could do to help restructure those assets. But it gave me a good understanding to the investment market because, at one point, as an asset manager, I had 200 and I think it was 242 properties listed for sale all around the country, and I managed those real estate agents. I figured out, really how to market a property, but what it really gave me was a good understanding of value. Where investors would want to come in and purchase properties at what price. And as an asset manager, you're always trying to get the highest price of your REO or real estate owned property, so all bank owned. And so, you got a good understanding of value. I mean, my houses were listed all across the country, so I really got a good taste of different things in different markets, and markets that were much better than other markets. And so I think at the end of the day, being an asset manager really drove the next couple of things I got myself into. I kind of dove into doing fix and flip myself in 2015. So, working for BSI Financial, really gave me the opportunity to kind of, not learn, but I'm a big advocate of learning while doing. I think in anything that you do, if you're hands-on working with someone else or partnering with someone that has done it before, it really gives you a good understanding to how to complete tasks and or how you can also fail. You see a lot of mistakes in this world. And so we kind of I jumped into flipping houses in 2015. I was using, I always make the joke. My first loan I got was a Tony Soprano loan. It was 14% and 4 points. The guy wrote a loan to myself personally, not even to an LLC. But we made money. At the end of the day, we bought right. We got some great contracting contacts that really did a good job, and we were able to make money even at those ridiculous interest rates and closing costs. And I think that's something that we can talk about later in this presentation. But it's really getting the know-how of doing something and having the right people behind you, partnering with you, really can make you successful. And while I was flipping houses, it makes sense to get your real estate license so you can find product, you can list your own properties. So, getting a license to sell real estate was really just a way to save money, but it turned into another really good synergy with flipping houses. You meet other agents, you network on having different people list properties. You get an understanding of your market and the different players in your market. So, being being a real estate agent really helped me just kind of expand out. So, I'm still hold a license today. I do a lot in real estate as far as selling my own properties. I sell some of my rentals, and obviously I have my own clients too. Um, BSI Financial transitioned. Well, I guess the next thing is the Birch Investments, which is a short-term rental company. And because of being an agent and flipping houses, I quickly I saw the idea of cash flow, rental properties. Long-term rentals were great. I've owned a few. I have a couple of 4 unit buildings, a couple of single asset rentals. But I gravitated to short-term rentals. They're always, in my opinion, nicer properties, um, better markets, and obviously the income potential is greater than long-term rentals in some cases, not all cases. And we'll talk through some of that in the slides to come. And then in 2017, BSI Financial kind of transitioned to Templeview Capital, which, when I started working at Templeview, it was great. We came out with a couple of products that really kind of really position themselves to help somebody that's looking to buy, renovate, and rent. We have loans for all of those things, and we'll kind of just cover these types of loans just so you guys can get an understanding of Templeview themselves. We are a national private money company. We're in 46 to 50 states. We concentrate our loans based off of the investor for fix and flip, bridge financing, ground up construction, and of course your DSCR loans. We have short-term rental DSCR and we have long-term rental DSCR. And we also actually have a new product that's a second mortgage for DSCR, and we'll talk about that in a little bit. These products are asset based, so we're not looking at the income someone has, assets they have. You can do these things with no income or no assets. Obviously, there's different products that could allow for assets for different types of terms. We offer advanced draws for our fix and flip. Obviously, these are investor loans. Rates and are published there. So we've got offices around the country, and again, you can work with us on a lot of different channels. We do have direct to consumer. We have channels for brokers that are looking to just broker loans to us, and we have table funding and correspondent channels as well. So any way you would like to do business with us, you can do business with us. I just want to cover just so get an understanding of the products that we offer, because this does really help you understand what it means to do BRRRR financing. Because you want to find value and create value, and you do that from finding a house that needs renovation and has upside. So traditionally speaking, when you're doing this, you're looking for a house in a good market that has good rental. And I always look for kind of a low vacancy rate, because that just means when you renovate your property, it's going to be one of the nicest listings for rental. Our fix and flip loan can give 90% of your purchase price, 100% of the rehab. Again, we have that advanced draw feature for people with some experience behind their belt. We go up to 75% of the after repaired value, and we do include the payments. We do have payment escrows, which is very, very handy, especially when you're doing BRRRR loans, because you want to keep money in the bank. You always want to have money, for things that happen, things in the property that you weren't planning on that you got to come out of pocket with. So you definitely want to have the opportunity to have some money in the bank. And so this is really a nice way with the payment escrows to keep the money in the bank and not make payments while you're doing the renovations. And these fixed flip loans can be with people with no with no experience. But we do have more graduated products for people with more experience, and the rates are going to be considerably less for people with more experience. Moving to our rental loans, our DSCR loans, again, asset base. We're looking at I put NIDA in there for people that might have been in the business back in 2005 or six. Thought that'd be funny. We go up to 80% of the purchase price, 75% for rate and term and cash out. Again, we do short-term rentals. We go down, and it says a one DSCR, but we do have products, and that's when the asset come into play, when you can show some reserves that we can go down to even a 0.75 on a DSCR coverage. Um, no seasoning, and you can use when you do the burst strategy. So if you put money into the property, you buy a property, you put your 20, 30 grand into making it rent ready. We can actually use the new appraised value. That's what it means when you're going no seasoning, to use that appraised value that you just created. We can actually lend up to 75% on vacant properties too with cash out. We go off of a 1007, which is a rent schedule. We can qualify for interest only payment. Again, this you don't have to have a big portfolio of fix and flip in order to do our rental loans. You can go in and do one loan with us through this program. I just want to touch a little bit on the ground up. Same thing. I have a lot of my own customers right now that actually do build to rent. So do ground up construction loans, which we do a 75% purchase. We do 75% land value too, which is great if you're doing a refi. We always try to get 100% of your construction included, up to 90% LTC, which was pretty unheard of for ground up construction. And again, these terms are 24 months. We like to include those payments as well. And for the build to rent aspect, it's one of the best ground up products if you're going to convert into a rental. You do have the luxury of a 24-month loan if you need to. Most people doing build to rent are building houses in 5 to 6 months because they've built them before. And these usually aren't really big luxury types homes. So you go in there, you build it, you can get it leased up, and whenever you're ready, you can refinance out into that long-term DSCR product for us. Quick little note there on the second mortgage loans that we have for DSCR. No income, no asset. It's up to 85% of the LTV. So this product did come up when people had done the burst strategy in the past. I mean, let's just call it 2021. I believe our mortgage rate for a DSCR, believe it or not, was like 4.125, if I do remember correctly. Very low interest rate on the first mortgage. And so those people, myself included, have a couple of those properties hanging around. We're not refinancing those, right? You can't even get close to anything in the fours right now on any type of product. Um, and so, and of course, this is something that's been owned for several years, so you have seen an appreciation in that house. So that second mortgage that is now available allows that person, that investor, to tap into that equity to pull out. The minimum loan amount for that is 35. Maximum loan amount is $500,000. And the only caveat, obviously, the DSCR has to be a 1.1 or greater. And it has a closed-end second. So this is straight cash out loan. It's not a HELOC, anything like that. It's literally a $100,000 loan, take the costs out, and you're going to get that cash in your bank right away. So that is the DSCR second. Products that we come out at Templeview are always, like I said, focused around the investor, how they can tap into equity, use what they have to scale. And that's really what the burst strategy is. It's scaling. It's using the equity that you create in a property. If you put in $20,000 into a property, that's the cash you put into it. You create value into that property. So you're rehabbing it, you're creating the value. Once you get it rented, you're going to have that income that supports what your payment is. And that's when you refi that out. And hopefully, if you've done it correctly, you've got your $20,000 back out and you recycle it. You repeat it and you do it again. That's what the burst strategy is. And in a sense, that's why it's so popular, because you're recycling your cash, using loans to get there. I mean, I do not fault people using leverage, using cash. Either strategy is fine. Cash is just taking, you've done it multiple times and you don't want to pay an interest to someone else. Totally fine. If you have that much money in the bank, great. But for investors that want to scale quickly, and buy more. And like think about it, if you're using same example I just said with $20,000, if you're buying $100,000 house and you had 100,000 in cash, there you go. You buy your house cash, you can do one property. If you're using leverage and you have 20,000 or $100,000, now you can buy five. That's why scaling and using our types of products here at Templeview into being able to acquire properties, renovate them, and then refinance them into a long-term structured debt um, is why I like to do it. I was really drawn to it because I was building my own portfolio of doing this exact thing. And we covered a lot of these points, but I put them up here just to talk a little bit behind the BRRRR method. And when you're looking at getting the money back out of a property and refinancing that property out, you've done a couple of things. In your market where you've done the renovation, you're creating a listing that looks brand new. So some people that you're competing with might have a rental property that's, a little bit stagnant. It's older, it's needs renovation. It's just a turnkey rental. So someone moves out, they paint, maybe put carpet in, but it's the same house. When you do your burst strategy, you're going to be able to demand a little bit more money um, into as far as the rental. Maybe your rent market is 1,500 bucks. Maybe you can go up to 1,650 because you're going to have a superior rental to someone else that is listing a similar bedroom and bathroom count to yours in the same market because yours is going to be nicer. Um, you're able to also pass on one of the things that you learn quickly when you're flipping houses, and if you're going doing a flip and you get a check for 30, 40 grand, hopefully it's more than that, but either way, you got to pay taxes, and they're going to be short-term capital gains. So there's going to be a nice check you got to write back to Uncle Sam, um, and that's why when you're doing this type of method, you're actually moving these gains into long-term capital gains. You're going to hold it over a year, hopefully over a year, and then you're able to use your depreciation methods and really use it for a tax benefit. Rental properties do a really good job with advanced depreciation. These are different things that I've learned while doing it and helping out on the taxes. So these are really good things that you can get when doing the burst strategy and keeping your short-term investments and moving into long-term. The other thing, quick note too is, if you do the burst strategy right and you get a really dilapidated property that needs a lot of work. I mean, you are going to renovate this thing brand new. And so a lot of times with rentals, you always want to have CapEx. Refrigerator breaks, AC goes out, repairs needed to the house. But in a sense of creating this turnkey rental property from the renovation, everything's new. So you should have the ability to have very low maintenance on the first 5, 6 years of your rental. And then you'll learn too, there's strategies behind what type of rental and product that you're putting in the property itself. And I'm a big advocate. Anytime you're going to be doing a renovation loan and your exit is going to be a rental, you're going to be doing different types of finishes, different type of flooring, just real durable types of things that you want to do out there. I mean, and just less things you're going to put into the bathrooms. I mean, this is a stupid thing, but I know I had a rental and I started out where the thing in the wall, like the hooks and the toilet roll kept breaking out or falling out of the wall. I mean, you don't need to put those things in. You just got to put the holders on the ground, things like that. You want to think it out. It's minor things, but these are things that you have to actually pay someone to repair or fix. So, these are just certain things I've learned while doing my own properties. I want to take a quick minute here to just kind of do one of my first 4 unit BRRRR strategy loans that I bought myself. I mean, I found a house on auction.com. This house was, I mean, $65,000. You don't find these too much anymore, but it was a 4 unit building that was just a complete shell, didn't have flooring. I mean, floors were completely studded out, but didn't have any floors. I mean, it was. I should have some pictures of this house before I got it. Um, at Templeview, we do have tiers. So we have a bronze, which is a 0 to 1 experience level. Silver, which is a 2 to 4 experience level. Um, all of our tiers will still go to 90 loan to cost. But leverage wise, when you get 5 or more deals on the bench, you're going to be able to go to 90% leverage, and your interest rates and points are going to be lower and lower. So platinum as our highest tier. So this was at this point I did over five, or I'm sorry, over 10 deals when I had bought this particular property. So I was in a platinum status. Um, my rehab loan was $150,000 to get this property up and running, and my ARV was 350,000. This market, just so you guys know, I mean, it's a 4 unit building, but it was still in the Baltimore market. So uh, that's why the ARV on a 4 unit wasn't, six, seven, 800,000. Um, but the 1007, the rent comp on this property was $4,200. So about 1,000 on the bottom level, and we got 1,100 on the top level per month. So the numbers were really, really good on this property. This is just kind of a breakdown of how a term sheet may look here at Templeview. This is dumbed down. Our term sheets have a lot more data, but wouldn't fit on this this slide. So I just kind of dumbed it down so you can see all the important information, all the terms. And just so you can see, just the purchase price, rehab, ARV, it factors in your loan to cost, your 10% down, your payments that are going to be included, and of course the cash that you need to come to the table with. It shows a $6,500 of an advanced draw as a credit at closing. You actually receive that after you close at Templeview, but again, it just shows your cost basis. So, I had to bring about 13 or let's just call it $20,000 or so to the table to close on this. And when everything was said and done and appraised for $350,000, when you looked at the payoff on the mortgage was $223,593. The monthly rent, again, $4,200. It didn't have to be completely leased up when you refinance the property. At the point of when it's completed and you have your certificate of occupancy and you're listed for rent, you can still do a loan with Templeview on a DSCR product. We're going to go off of the 1007 on this, and because the renovation was completed, and when you do the rehab loan with us, we know there's a renovation component. You don't have to do it with us. A lot of people might buy something from auction, pay cash, renovate the property with their own cash, and then it's ready just to get the long-term loan, which is totally fine as well. Still go off of the appraised value um, of whatever the value was created. And so, you can see the taxes, the insurance are in there. Paid a point, and the loan interest rate 6.5%. Bought it down a little bit. I was able to get to 75%. DSCR was still over 1.3. And then as you can see, I got a check at closing for $32,000. I was into that property for 20, from what I brought to the table. And I did do some things outside of my budget, which was another $10,000 or so. But for purposes of the example, obviously I got more money out than I actually brought to closing. And that's the definition with the BRRRR strategies, because I can take that $32,000 and I could put that into my next deal. And so this is why the BRRRR strategy is so important, or so popular, just because it's a way to create the equity. And with leverage, we give you the way to take that equity back out. And so obviously the results we kind of talked about, the investor got paid $18,000 to do the deal itself. But the underlining positive future of this property was it's literally I'm making $2,000 a month when it's fully occupied. In Baltimore, you're going to lose a tenant here and there. One's going to go out. You're going to have some vacancy. I do tell people all the time to account for vacancy. And when you have a really good tenant in your property, this is something that I've learned over time. When you have the person that's paying you every first and fifth, between the first and the fifth of every month, you want to do everything you can to keep that person happy, keep that person in your property because, like I said, when people have a motivation to pay and you give them every motivation, I used to self-manage a lot of my long-term rentals. And so I was hands-on. People called me on my cell phone. I was there. I had gotten bigger, so I had to pull on some property managers. But property managers are gotta be the same as you. They gotta have that personal relationship with some of these tenants because tenants are people. Like sometimes tenants, if they have an admiration and they care for the landlord. I mean, it's a different type of care you're going to see at your property too. If there is a if they don't like the landlord, the tenant, trust me, you will find out with the care of the property, and you will get some ridiculous requests that they want fixed, and it's my experience, and I've done it both ways. When I had one property that I didn't know any of the tenants, I didn't place any of the tenants, and guess what? We definitely had some issues. We had some people not paying. We had to do some evictions on the properties that I handpicked, and I met the people and I put them in the houses. I had a really good experience, and to this day, I have some renters that rented this house. I have two that are still left, and they've been renting for 5 years on this property. So, like I said, I do think there's a level of respect from both sides that if you give it out and you keep your tenants in play, you should have much lower vacancies than if you're not hands-on, if you're not responsive, if you don't really care to keep that person happy that's in the house. So one thing to take away from, getting the the strategy of your tenants and your placements, but definitely whenever you're doing calculations for rental properties, make sure you account for your vacancy. I mean, I think everyone says put 10% vacancy in there. I think as a lender, we always put a 10% vacancy from the lending aspect. That's because what's Wall Street calls for. But I would always put more, 15-20% is something I would calculate for. Um, these are just a little bullet points of the way you can apply BRRRR for investors. This is investors is the wealth game. We've talked about a lot of these points, but the idea behind the BRRRR strategy is just the underlying upside of creating equity in property and be able to access that equity almost immediately and pull the money out is really why investors like this strategy a lot. And from the aspect of a real estate agent, if you're a good agent and you know your market very well, you're able to create relationships with other investors from the a real estate aspect to, hey man, this is a good rental. You're going to need to put some money into it. And from a real estate aspect, you're going to be able to typically get, I have a lot of referral partners from real estate agents. One of the good things with Templeview is that we are we're non-trid and we can have relationships with real estate agents that we can confer as clients. And if you are a real estate agent, we have ability to pay you guys, which is great because the referral is very important to us. And we want to also take care of your client. And you as the agent want to look good, so you're referring them to a company that can actually get the deal done. Um, and most people that are doing the burst strategy have the cash after they've refinanced is complete. And a real estate agent loves that because what they're doing, taking that cash, hey man, I know you got 30 grand. I got this other rental ready to go. And so you're continuously recycling that for that investor, finding them different properties. And if when you're in that type of world as far as real estate agent, I know for myself, I there's some times that just I got too much going on. I might know of a good property that's on the market in my area. And listen, as a real estate agent myself, I bring it to my clients that I know are in that same market. Hey, I got a great deal for you. Let's put an offer in. And when they have that relationship, the ability they know that you're going to be able to close. So as an investor, if you're buying from an agent and they know you're a closer, listen, they want to find you properties. So from this aspect of the real estate agent, you want to know that investor that's always be closing. And as if you're an investor yourself, you want to prove to these agents that you can close these loans because they're going to continue trying to find new properties. And that's the goal is really having someone else looking for opportunities for yourself so you can continue to build what you have and have more opportunities coming in. And of course, from the aspect of anyone on this line and on this webinar is a mortgage, lender or broker, we all know that investors are doing, if you're a broker, if you're getting somebody on the hook that's doing the BRRRR strategy, you have the loan for the fix and flip, and you have the takeout loan for, your DSCR. Okay. Most savvy investors are doing 6 to 8 deals a year, which, if, 6 to 8 BRRRRs a year, if you're scaling that out, I mean, that's could be anywhere from 14 to 16 loans from one borrower. And that's why you see the partnerships come into play. I think, you know, I always stand by the term a good deal will always get funded. And so, some investors might bring me a deal and they say, look, I want to use this as a rental. But when you calculate all the numbers, there's no upside. There's no ability to take that cash out. And we don't, if you're going to move to a rental, we don't have a requirement that you have to make money on the actual flip itself because you're going to move it into a rental, but it has to have a good rental rent schedule. So if you're doing all that and you're not even at a one DSCR, hey man, it's not a good deal. A lot of the people that I work with directly know that I'm an investor myself, and they might even, chop it up with me before they put a contract in. Hey man, what do you think about this property? Most lenders if you're an investor on this line, and you're learning or from this webinar, you want to have those relationships with lenders, especially people that know what they're doing and they know their markets, because they can give you feedback. Hey, this has been really successful. I know this is a hot market. Oh yeah, they might even help you with some of the things that have been successful with other investors. Because they've seen it work itself out. I mean, they've seen the acquisition loan, and guess what? They refinance out. And, hey, they're appraised for X. I mean, they might know where that appraisal might come in and give you some knowledge of that. Some of the other things in today's market you have to be aware of is this in an area of decline? You gotta do pro formas for everything. You have to also be able to pivot if something's not going your way. I know there's a lot of people that were doing flips in certain markets in the country, and they had to pivot into a rental because they weren't going to get the ARV that was going to, make them the money they were looking for. But hey, it was a good rental market, and some of these markets have different rental plays. So I wanted to kind of go into that, like, if you're buying in a nicer market that might have a draw for short-term rentals. Short-term rentals was something I kind of fell into because when I was, in the good old days, I called it, in the early 2000s, I made a lot of money with the wholesale mortgage company. And then instead of buying stupid toys, I ended up buying real estate in different vacation markets, Florida, and I bought in Ocean City, Maryland. And what happened at the point of the crash is that you know, we were over equity. The house was worth, 400,000. I'm sorry, I owed 400,000. It was worth about 300,000. And the problem that I saw was the long-term rental market wasn't going to hold the debt. So if I did long-term rental, I was going to lose $2,000 a month. And so I kind of fell into short-term rentals, and what happened was, I just needed to do it to pay the mortgage. And I was a lot younger then, so again, I was just figuring it out. This was 2012 when I started kind of putting one of my rentals on short-term rental without knowing anything that I was doing. And I will say that it was a really good learning experience because owning and managing. So I self-manage all my short-term rentals. We have 15 active on Airbnb right now. And for me, it's more turnkey because I have a process behind what I do. And I know that when you're buying short-term rentals, it's completely different than long-term rentals. You do have to do accents, you do have to do trends, you do have to spend a little bit more money. But we also know on the lending side, you're going to have a higher market. And one of the things that we worked on at Templeview was to figure out how to calculate the short-term rental income. And that's one of the things. There's a lot of data out there, AirDNA. There's a lot of different sites that can show you the potential income. Um, I know when we were looking to get this loan approved, I was able to show Templeview and the powers to be, hey, look, I had a W-2. W-2 said $33,400, and it was the same on the AirDNA website. It was the same data. So it really kind of proved that the data was right. And it is. It's really good data out there if you're doing short-term rentals. And just to prove the point I was saying before, the long-term rental for that same property I got $33,000 on was about, I think it was like less than $20,000. So, it was almost a 2x of where I was at on short-term rental versus long-term. Um, and you get some feedback from Airbnb. This is where I host a lot of my programs of where your performance is. As you can see, you have searches. They have different things. They say, okay, you have searches for houses. And when I saw the first one, 158% of searches for houses that this was the two bedroom, that where it said the performance on the first one was at 158%. And then the second slide there is a three bedroom. And uh, when I saw 1406% of listings that have increased for the three bedrooms, I lost my mind. So I started buying up different properties in that space, and that data was so important. And I got to tell you, it wasn't lying. I mean, I think I purchased a property um, and I was driving to the closing, and it booked 9 times while I was driving it. Because a lot of times when you're buying a vacation home, these are turnkey houses. So, when you're buying them, a lot of the pictures are going to look the same because they transfer all of the furniture and things inside the house. And so I just listed it with those photos. They were fine listing photos, and it booked 9 times. I didn't have a cleaning fee. I learned my mistake, but just to use the tools that are out there to really figure out how to buy and where to buy, because I mean you can get a lot of value from just picking a certain market. I think a little lesson that I would tell people is you pick markets when you're starting out in the investment world that you actually go to. If you have a family, I love Ocean City, Maryland. I got three young daughters. They love the beach. So I'm very familiar with Ocean City, Maryland. Um, I got connected with real estate agents in Ocean City. They know I buy the worst properties. They know that I close, and so I'm usually getting a phone call on something in the Montego Bay area because they know I'm going to be able to buy that. They know about my financing. They know that I can get closed. They know I know the process, and so being able to do that, and you're in a certain market, value, and everything about what kind of income and what other things that you need to do to just make that into a performer. I did on the one that I bought that said 14.06% increase. I mean, that was a two-bedroom house that I bought, but it had a really large laundry room. And I remember breaking the wall, moving the wall over. I think it was like 2.5 feet, and it was big enough to just be a small bedroom, so a three bedroom. Not a big renovation. We did it in about a week to create the conversion from a laundry room to a bedroom, and the increase in the daily rate. The daily rate in short-term rental would be what you get per night on a two-bedroom. At that time was about 175 to 200 bucks, and the three-bedroom was anywhere from $300 to $400 a night on prime time. So definitely know. I talked about a lot of this, but definitely know, when you're doing the BRRRR strategy for a short-term rental. If you could find something that is foreclosed or does need a renovation loan, great. In some cases, you are going to want to structure or know where you're going to be at if you can purchase that on a bridge through Templeview, or if you can buy it straight up on a long-term DSCR. There's different ways. Again, you want to call myself, one of your mortgage professionals to kind of tell you where you're going to fall if it's a turnkey property versus using a fix and flip or a renovation property. Um, Okay. This is, for the investors on stage, like I said, just going through some of these slides. I mean, you definitely want to understand how leverage works. I want to leave some time. Let's see where I want to leave some time for some questions. We've got a couple of questions in the chat so far, so I'm gonna try to end this in about 5 or so minutes and then move to questions. So, again, if anybody on the line right now does have questions, anything came up, please put something in the chat and I'll address those in about 5 minutes. Um, so, like I said, if you're using the leverage to create value, taking the DSCR loan, refinancing out, and being set on long term, you know, still there's ability. The number one thing I always tell people is make sure you have some money in the bank. Be responsible when you get your cash out, not just take all that money and put it into the next property. Do have some money in reserves because again, you have to lease it up. Make sure you don't have any issues because you want to once you get it leased up and you have a great tenant in there and they're start paying, you're going to start making money. And like I said, that's probably the biggest thing I see with new investors is that they love the idea of scaling, creating wealth. But one of the biggest pitfalls people fall into is just not having enough money in the bank to meet the demands in case you have some vacancy. So the other thing I want to talk about is the different types of opportunities out there, because you have your long-term cookie cutter rental, but right now, and we talked about pivoting, changing markets, declining markets, but there are definitely new trends out there. There's something called workforce housing. That this is another great ability to just maximize your returns in your property. They're not for every market. If you look into workforce housing, a great company to look at is something called PadSplit, padsplit.com. You can look them up. They have, and they're typically going to be in a very strong work environment. They don't have a lot of, efficiency houses, some places like Tampa, Houston. They just moved into Baltimore. Definitely somewhere to look for for a nice pivot. There's something called midterm rentals. So if you have furnished finders, midterm rentals are, it kind of came about with traveling nurses. The good thing about a furnished, like someone from a midterm rental, furnished finders is something that instead of like a short-term rental, your average stay could be 5 days. On a midterm rental, you're looking at 3 months, your average stay. So you don't have enough turnover, but the market rent is always going to be higher. And so a lot of people have pivoted into so for me, just to give you an example, a lot of my vacation homes are seasonal, right? So um, this is a good takeaway for anyone that invests in Airbnbs in a market like Ocean City, Maryland, where you're going to be booked from typically the mid to end of May, all the way. We have a couple of festivals now in October, so really get some good rentals all the way through October, and usually the holidays. Your New Year's Eve. You're going to get some people at Valentine's Day coming in, but I tend to turn it over to the municipality service providers. I reach out to people that are going to fix the roads, people that are going to work on bulkheads, because we are in an area with a lot of bay access. And so McLean was a really big service provider that ended up renting my houses, and they do all the work in the off season. So I try to keep my vacancy level, um, very, very. So I want people in my place all the time. I don't want high vacancy at all. So, I would go out to them. I would just take it off the app, just cancel off the months from, the mid-October until basically mid-April. And then I would do a midterm rental back to some of the municipalities. It really keeps people in there. You're not getting the same money you're getting from Airbnb, of course not. But instead of getting no money or one or two rentals, you're really getting 50, $75 a day. So you have to just really know the market. So these are just for different ways that you can kind of build into what and what can make you the most money. And so I'm always looking for the next thing. So I hope you guys enjoyed this. I hope you took some things out of it. I'm going to take some questions, and I'll leave my contact information up here for anyone who wants to grab it. I'm going to the questions. Um, and we have one from Natalie Scalar for STR. Will you look at STR income versus long-term rents? Good question. And this is actually from terms of your short-term rental financing from the DSCR aspect, we want to see a 1 year rent roll. Okay. A lot of the data from AirDNA, they have found it's really difficult when you start an Airbnb to have the same data as someone that has an established short-term rental. And so, one thing to keep in mind, it's a great question. When you're going to, for us, for a short-term rental loan, you want to have a rent roll for 1 year to be able to use the higher income. So in my example personally, I have a 4 bedroom house. It's near Bethany Beach, Delaware. That house has a market rent of $2,200 a month. Okay. My short-term rental income is $6,700 per month. And my payment on that is, I think, is around 2,900 dollars a month. So it doesn't cash flow on long term at all. So when you're buying something like that, you're going to do again, if you're doing a renovation loan from Templeview, we can actually write a renovation loan for up to 24 months. If you're doing a renovation loan, you're acquiring a property that needs renovation. You finish your renovation, you can stay on your renovation loan for up to 24 months to get your rent roll. But what a lot of people might do is just refinance into a bridge. We offer payment escrow. So instead of taking cash out, you can just do payment escrows for 12 months. Once you do those payment escrows, and you get your rent roll, guess what? Now you're able to use the 6,700, and obviously based on that payment, it's a 2x DSCR ratio. It's a really easy loan to close, but you do need the rent roll in order to do that. So again, partnering with us at Templeview, you have access to, a long fix and flip product or a bridge loan when you need to convert, wait for the 12 months. And either way, you're going to be able to get to that DSCR for the 12-month rent roll from your Airbnb. And we had another question just about lending in Chicago. Chicago, we are. I'm finding we're one of the few lenders still lending in Chicago. We do have overlays in Chicago, so you're going to see instead of a 90% acquisition, you're going to be capped at 80%. One of the things in Chicago, and I have a couple of deals right now in Chicago with some great terms. It has some great yeah, great numbers on it. So I think a lot of what's going on in Chicago is the default and the ability for a bank to take back properties. I will just kind of make a little ad about that, just so you guys can start thinking about different things with the default side of things. Most lenders are going to lend based off of the default rate. So people use the terminology ARV. So if you lend off of the ARV of a property after repaired value, that's usually capped at what the default number is on that particular property or town. So, in Chicago, for example, most of the notes, the defaulted notes are going to trade from 65 to 70 cents on appraised value. And so that's where us as a lender is going to cap where we're going to lend in a specific area. So in a lot of cases, that's why we go all the way to 75% of the after repair in different markets, because a lot of default notes are trading between 70 and 80 cents, which averaging out to about 75 cents of appraised value. So that's where that number comes up with. So, good questions. Is there anyone else here that has any other questions on anything I spoke about? Any ideas? I'll stay on for a couple more minutes here in case someone has another question. Um, and if we don't get any more, I just want to thank everyone for taking, some time out of your busy day to sit there and learn. And hopefully you got some stuff out of it, some things that you can put a call to action on, whether it's your first rental or you're on your 10th or 11th. I am a big advocate of partnering with a lender, someone that knows what they're doing. that can give you some advice and obviously partner with you to get your loans done in a timely manner and allowing you to, close on the acquisition, refinance your house into that rental loan. Of course, giving you cash back to reinvest. That's what it's all about. Oh, got one more question here. Got you. Cool. I will we got my number right there on the screen there. So if you want to send me a text, I'll grab your number, Byron, and give you a call. Thank you guys again. My name is Mark Birch, Temple View Capital, Business Development Manager. And I look forward to talking with some of you guys in the future. Thank you so much. And Brian, I'll just go ahead and get your number here and I'll give you a call in just a few minutes. Thanks again.